Welcome back, everyone, to the European VC podcast. Today, I have another episode for you that is fully focused on CVCs. That means we're talking to Mike Smeed from InMotion, the CVC arm of Jaguar and Land Rover, JLR. It is a conversation that I think all of you should be tuning into with a couple of things in mind. First of all, of course, to better understand the CVC background of and what they're really dealing with when they're working with their partners or with their parents, and then of course also a lot about how you can engage with them, because I think there's something truly special here that's important to learn. And Mike talks a lot about the power of collaborating in the industry and how he has gained so much from it, but also what parts around the way he works that as partnering VC can really take away from a partnership approach with the CVCs. So I hope you'll enjoy this episode as much as I did making it, and I hope you'll welcome the CVC podcasts into this flow of episodes.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.
This show is not investment advice, and the hosts of this episode may be invested in the funds and companies featured.
Mike, welcome to the European VC podcast.
Thank you. Thanks, Andreas. Thanks, JP. Thank you for having me.
And I should actually say the EU CVC podcast almost, because this is one of our new podcasts that are focusing on the CVC landscape, and it goes out on both our platform and Jeppe's, which is going to be a dedicated platform, or is a dedicated platform only to corporate venture capital, because we're really trying to bring together these two sides of the industry a little more. Mike, let me just read to you basically your intro, so that you can then add a bit of context to it and tell me where I got it wrong. You're up for that?
Yeah, of course. Go on.
Mike, you're Mike Smeed, the managing director of InMotion Ventures, which is the CVC for your parent company, JLR. And you're investing, of course, in exceptional startups that accelerate the pace of innovation and delivery of JLR strategic transformation. So that's a bit different from our normal VCs, because you have a very strategic purpose. You're based in the UK, and you're one of the most active corporate investors in the UK. You're a team of 7, with 5 in the UK, 1 in the Bay Area, and 1 in Tel Aviv. So the main hubs, as one would expect. You are investing C to Series A, but you do have the flexibility to invest at B with sufficient pull from JLR to helping you do that. Typical check sizes of 250K up to 2 million. You're investing in climate, industrial, and enterprise tech that are critical to JLR strategic transformation. And you're focusing on the UK, Western Europe, North America, and Israel, thus your locations. Your investments, if we talk about some of the notable ones that people might know, it's Ascend Elements, Uncaged Innovations, Beyond Math, Chipflow, and Firefly. Did I get some of that right, or did I leave something out you think was important?
No, you did very well, and it saved me five minutes of the introduction. No, it's as you say, we are a strategically focused CVC, but we are financially driven in the investments that we make. And I am sure that Jeppe is desperate to get into a strategic versus financial debate, and we'll hopefully we'll do that later. But yeah, it's really important, and really delighted to hear on your introduction that you talked about bringing CVC and VC together, because particularly in the UK and Europe, we've got a lot of work to do, I think, as a community, and that's both VC and CVC, to really start to work together in a more collaborative way, and in the way that we see our American colleagues do it. And I think we've got lots of lessons to learn, and there's lots of news, particularly in the UK, France and Germany at the moment, and I'm sure you'll tell me Denmark is the same, about what we're looking to do to grow investment, grow private companies, in Europe, because we have as much quality in terms of research, development, early stages, but we all know our problem is growing them in that critical growth stage. So no, I'm delighted, and thank you for sharing the introduction so well.
And adding a little bit to that, Mike, right? There came some data out this week from Mind the Bridge, right? Europe and especially the corporates in Europe are getting behind the game here. So we need more corporates in there, and then we need to bridge the areas towards the standard VC startup ecosystem. So really looking forward to learn more from you, Mike, and how you do it at InMotion.
I'd love to ask the both of you to comment on a statement that I heard this just yesterday. Actually, I heard from a very notable VC in the European ecosystem when we were reflecting or discussing on the we were looking at a chart that was basically describing where the capital to European venture came from, and you could see that in 2022 we had a huge bump in corporate investors, which then has definitely dropped off a bit this year and last year. I'd love to ask you, because what his comment to it was then basically they all got in on in the top of the market, and then everything went south in our industry with the tech reset, and now they're blowing up and they're going to be gone for a long time again because the industry is not sexy right now. Is this the trajectory you think we're on? Do you think we've learned from past times? Do you think that them coming in 22 and 21 actually made them coming in so close to the tech reset that there were some very early learnings, which might have done, it's different. It's different, I think, if you experience this when you're just setting things up and then you realize that it's tough versus realizing that it's tough when you're 3-4 year in and you're already looking at that corporate initiative, venture initiative saying, you got to deliver now. And then you're like, well, we just hit a tech reset. Now is not the time to tell us that. You said something very relevant in this context before we started recording, because you said, well, I'm about 2 years in now. So you follow that timeline pretty nicely.
Yeah.
So maybe your own experiences fit well here.
Yeah, I mean, I think there's so many things in what you've just said, and I think that it again, and JP will be able to talk a lot more about this than I can because of he's been involved in this a lot longer than I have. But I joined InMotion from a part of JLR. My background is in the finance world. I was the CFO of JLR's joint venture in China, and I came back to the UK to join the team and lead the team in 2022. So I've only been doing this for 2.5 years. So obviously JP will be able to comment a lot more intelligently than I can. But in terms of the reading that I did, I think there has been definitely a historical view of CVCs that they do go running in the hard times, and that in corporate investing follows the economic cycles of the company, and therefore when things get tough, they go run and hide. And I think that's a very old view of the CVC landscape. I think if you look at, I'll touch on that, and then I'll come back to your comment on the investing, at all. We know that in the last 10 years, corporate investing's gone from about 15% of overall VC funding to about 29%. So, if anything, over that past 10-year period, things have been growing. I think, without a doubt, there are people who've been doing this a lot longer than I have, and we talk to them at events such as the Global Corporate Venturing summits in the US and London, which become very much therapy sessions for CVC leaders. And the guys who've been doing this for 10, 15, 20 years will say that, things are difficult at the moment. The exits and IPOs and M&A that historically you could rely on to become self-funding, just aren't there. So a lot of questions are being asked, I think, where potentially CVC models aren't as well thought through, they're not as well aligned. Maybe they are wholly dependent on one individual in the company, and if that individual leaves, then you're in a bit of trouble. I think overall, again, if I compare, and I probably can't talk about all levels of investing because we're obviously focused on certain areas of it. But if I look certainly at sustainability, we, without a doubt, we saw a big peak of investment in 2022. But I think a lot of that was situational. There were a lot of, particularly in the transition to EVs, there were a lot of investments in big companies, at that point, which were, pulling a lot of capital into those very specific companies. And we see, very topic in the Nordics at the moment is the situation with Northvolt and, the amount of funding that they took from, a lot of companies, probably over that period, in the billions of dollars. So I think that, I would like to think that CVCs are becoming more resilient to that. But without a doubt, we're seeing some of the valuations of those companies, in 2021, we're seeing a lot of internal rounds, bridge rounds, down rounds in certain situations where, people were raising money at incredibly high valuations with low levels of traction. And I think that, again, we're seeing some of that again in the AI hype, right? We're seeing that going on at the moment. And there are lots of people putting lots of money, making lots of bets in particular areas. And that's where I think being really clear on what it is you're here to do, what it is that you're investing in, kind of reduces that risk somewhat. It doesn't,
and it is the strategy, right? I think one of the reasons why we're doing this show, right, is to broaden the understanding of the strategic toolbox that corporate venturing is, right? Because it's a fact that the average lifetime of a CVC is around 3.5 years. 60% of people working within a CVC claim that C-suite and board does not understand what they do. And we are behind in Europe, right? The latest data shows that Europe is falling further and further behind, right? So we have to pick up that game. Mike, you also said, right, you are a separate entity when we talked earlier, right? So that is a stronghold for you. But when you look at the balance sheet investors, they are challenged, right? Because when you have that financial downturn or upturn, right? When you have the upturn, that is where the corporates come in and establish their venture funds, right? Because then they have more money. But when you then get above that and you start going down, right? Then you have a business entity that does not create any revenue, but it's burning a lot, right? The easiest when you do cost cutting is to take that entity and remove it. And that is why you have the fairly short average lifetime, right? So we need to broaden the understanding of the corporate venturing toolbox.
No, I completely agree. And, one of the things that we were very careful to do, or I was very careful to do when we reset our fund when I joined, was to make sure that the communication was something that we really took as a really high priority. And I think, again, Jeppe, to something that you've just said, again, I'm very, very lucky, right? There's a lot of resources that are available for people. A lot of it is US centric, so you have to be able to convert that into your European context. And the key thing for me was to make sure that we weren't wholly dependent on one person. So within the board, sometimes we report functionally through. My boss is the chief strategy officer of JLR. We know that. There tends to be either the chief strategy officer, the CFO, or the CEO tend to be the three typical kind of board, unless you report into the board yourself, as some kind of CVC leaders do. And therefore, it's really important that, as you say, the 3.5 year tenure is simply because the average tenure of a CEO, CFO, or CSO is 3.5 years. It's no shock that these things are linked, and therefore, we've been really careful about making sure that we're investing across the whole business. So, when we have the opportunity to talk to the board in an official board meeting, or we talk to board members, that I'm not just talking to one person in the room. And to your point, the other 7 are just looking at their phones thinking, who is this guy? Actually, we're talking to each of the individual members to say, look, this is how we're supporting your team, your function, your deliverables, your strategic imperatives. And Andreas, as you said in the introduction, we're really clear. We exist to help accelerate JLR's strategic transformation. We're not here because I think it's a good idea and I'm going to go and invest in stuff that I think is cool or exciting or all of those things. We've got to make sure that it's really tangibly linked to the strategy, because when it does come difficult, as you say, it is difficult right now because we're not seeing exits, we're not seeing all of the things that we maybe did see in the previous periods. And we are an off-balance sheet fund. Even though we're a separate entity, we do invest off JLR's balance sheet, and we found that to be incredibly helpful because our annual capital allocation is not that great. So it's not a massive amount. So therefore, when we do see something that's maybe outside of our thesis in terms of stage, then we have the ability through a bit of Excel magic to have our allocation grown because we take money from another business unit or another function, and that helps us to provide that flexibility in our investing and in kind of doing that way. But the other thing that I've learned, and JP, it'd be great to get your perspective on this, is that what a CVC does, how it's set up, how it operates, is so dependent on the parent company. Because I talk to some of my peers, and I think I would get fired if you ran the team the way that you run it, or you approach this, or you approach that. I'm like, there's no way that would work. So it's so dependent on the way it's structured and all of those things that it's one of the most fascinating things about it, right?
Yeah, and everything you have said here, Mike, I'm so I'm getting excited, and I'm getting really, it seems like you have cracked the nut a little bit, right? Because you are financially driven in what you do, but you have the right strategic rationale for why it is that you do what you do, right? And I think this anchoring yourself into the mothership is super important to get out all the value of it, right? So I think when you talk about how you can engage with C-suite and board members and so forth, that is the right way to do it. I think to extend this, to more than 3.5 years, you have to have that mapping, right? We do this for this reason. It costs this, and this is the relevant KPI for the success, right? Because a lot of the survival for InMotion and other CVCs is related to how do you prove that you are a success, right? So you have to have a lot of these softer KPIs in there.
No, definitely. And sorry, Andreas, I'm just conscious you've only asked one question, and
go, guys.
We've just gone off on a conversation.
To everyone listening in, so as always on our content, we have a super large script, a lot of things that the guest has prepared. We don't necessarily get through it all in these episodes. That's why we always say it's one thing to listen to the episode. It's definitely another thing and very additive thing to go and also read the show notes that's on our website connected to this, because there are definitely points in both that we don't cover, right? So, and I don't want to force us into going through our script here. I want to have the conversation, and I know that we then have some core points to also cover. So,
great, yeah,
please just talk.
Yeah, no, because it's such a fascinating conversation, and this is why I am so excited about CVC, because particularly as a newcomer, and my background, I've spent 25 years as a finance person. Being an FD and a CFO and all of those things. So I naturally come at things with a very suspicious mind, and I wonder. But to your point, one of the things that we did was, when we looked at our reset, not only did we think about the types of investments we wanted to make, we thought about what type of investors did we want to be. And I think that's really important. And it goes back to JP, your point there, is getting that alignment onto why you exist. Right. What? And I hate to use the word value because everyone talks about value added this and that. But if we become a cost center, then we're dead. Right. Because otherwise we are, some nice to have, function that, goes to lots of conferences. People in corporates think that conferences are really exciting and interesting. And you just turn up at kind of, 10 o'clock in the morning, you leave at 4 and you might go and see some nice cities. I mean, I've just come back, 2 weeks ago from Slush, and we had to cancel our recording last week because I was, came down with a cold afterwards because, for 4 days you don't stop, right? The first side event we had was a run with at 7 a.m. and then you kind of crawl back to bed at 11 p.m. and then you go again and again and then
you do the sauna and then you do the ice dipping and all of that, right? And then you get home with COVID, right?
Absolutely, but those are the types of things that being very clear on, and again, just talking about our rationale for investing is look, we recognize, as well as many kind of corporates do, is that real innovation is not happening in big companies, right? So you've got to be able to engage externally with either, big suppliers, universities, as well as startups of varying degrees, right? And therefore, as you work through looking at these things, and we've studied even companies that you would think are the most innovative in the world, like, the NVIDIAs, the SpaceX, and all of those things. If you look at, and CB Insights do an amazing, work of looking at strategy maps, like, they haven't done this all themselves. They've either partnered with companies, they've acquired companies, they've invested through their CVC arms, in things. And therefore, looking at that world is something that we think is really important. Having an investment arm gives you credibility in this space. And by the way, you have to earn that credibility. It's not a right, because there are a lot of corporate innovation tourists kind of walking around going, oh, this is great. Let's have a lovely conversation. Let's take up lots of founders' time. And then things never go anywhere, right? We know that happens. And therefore, being able to do that and allow startups and our corporate parent to interact with each other in a safe but productive way, I think is the value that I add as an individual, and I think what our team adds as well. Because if you look at any large, and you'll talk, Jeppe, about your experience as well. Large companies have functions that have been developed and are created to prevent harm coming from, to that company. And particularly in industries like ours, which are heavily regulated, for the right reasons and all of those things, it's really important that those functions kind of exist. If you just try and take a startup and throw that into that kind of lion's den, then just nothing happens. And, there's frustration everywhere and all of those things. So I think having us in the middle, and I've spent probably a third of my time acting as a bit of a therapist to our portfolio founders, helping them understand what that interaction was, what that conversation was, what's in the mind of the person that you were speaking to try and do that. Now, that's part of our role, but also, what we're looking for is to introduce startups into the parent in that way in which something happens, right? And now that could be because JLR has an open innovation kind of like a venture clienting function where they manage proof of concepts projects and things like that. So we don't have to invest in every company that we introduce to. We're looking for those exceptions. And that comes back to the financially driven piece, in that if you make an investment in a startup, it's got to be on sound VC-led principles, because we all know the power law. We all know, kind of we're not a corporate development function. And that's so, so important. So you've got to be able to bring back those venture style returns in some way, shape or form. Otherwise, you lose credibility internally, I think.
But I think there's some really nice observations here, right? I think the one about startup tourism, what I really appreciate with what you do, Mike, is that you do the direct investments, right? You engage deeply into the ecosystem, because you could say normally the normal starting point in corporate venturing would be to do the corporate clienting part, right? The collaboration between startup and corporate, it's also a cheaper way of engagement. But it does not stick, right? It's not where you are all engaged and all the co-investors in the ecosystem see you as a true player in there, right? And, a startup engaging with a corporate without equity, I'm wondering, how much effort will they really do to that corporate, right? So that is where you get the better engagement in my view. Then an interesting observation from a former participant on the show, Gina from Emerald. She said, don't focus on the unicorn part, right? It's so seldom that you have true disruption happening to a corporation. So let's be mindful of also, this is innovation. This is looking into the future. It is to see the early opportunities that are out there, but the disruption seldomly happen.
I mean, if somebody from, if Gina from Emerald is saying that, then you got to listen, right?
Yeah.
I mean, these guys know what they're doing.
That's a word.
Yeah, but I mean, I think it's a point around, and I read recently someone say this, any corporate, venturing, whether it's venture clienting, venture investment, it lives and dies on the quality of its deal flow, right?
Yeah.
Of the quality of things that are coming towards you. And you're absolutely right. We believe that being an investor opens so many more doors to us than if we didn't have an investment arm. Now, obviously I'm biased, but and we're seeing that, even in one of the investments we made, in a company called Chipflow, which is looking at designing custom chips, custom semiconductors, because a lot of the issues that big companies face is everybody's working with the same big chip manufacturers. And of course, what they want to do is produce billions and billions of exactly the same chip, because that's the way that, the manufacturing process works. Now, what happens there is you're ending up with varying degrees of utilization of what goes on in that chip. So what you want to be able to do in an ideal world is produce what you want, on a chip, and Chipflow enables you to do that. Now, the only reason that we got to invest in that company was because a VC came to us and said, look, we've met this company. We think they're great. They've told us that there's a potential use case here, in automotive. Can you guys, can you help us with that? Can you understand it?
Yeah.
And we were able to then take that away. We worked with, our semiconductor experts in the company, which again, I believe is a really important piece of the CVC advantage that doesn't exist in VC. I have access to over 8,000 engineers across the globe who are experts in particular areas. Our technical due diligence is something that is so quick and easy for us to do, but incredibly valuable to the startup founders because of the range of things that are going on, at the moment. But we were able to bring that technology, that founder, that startup to the company, and we never would have been able to do that if we hadn't have been knowing and created a network within the VC. And this is where I think, as we started this conversation, bringing VC and CVC together is so important. I go to lots of events in London, and sometimes we could be the only CVC in the room, and it's full of, or you go to a CVC event and, there's no VCs there. So I think we've got to do more to bring together.
It impressed me a lot when I read through your script, right? I think that you're being invited into deals for who you are and the brand that you have built in InMotion is super impressive. Could you just share a little bit on how do you engage with VC normally? Because we also have the crowd listening from the VC side, right? What is a perfect co-investor from your side?
I think for us, look, and I've also got to say I'm incredibly lucky. Our investment team, Sam and Louis, based in London. We've got Will, as you said, based in the Bay Area, and Maria in Tel Aviv. We've also increased our team recently. We've had Eddie join us as our associate. So I'm very lucky. I've got a very high quality, incredibly talented team, and importantly, they come with a VC background. So I'm the only kind of JLR corporate person in the
that's interesting.
In our team. And I think that that's another growing trend. So if we go back to a few years ago, I read a book before I started, and it was said, the last thing you want to do is to bring an insider from a corporate to lead your CVC function, because, it'll just get destroyed. You'll end up in corporate development and all of those kind of things. But actually what I've seen more recently is a number of, whether it's Dan at Enterprise or Anne-Sophie at Volvo, these are internal, hire from the parent into the CVC, but underneath them are proper, if I say that, VC professionals, right? They know what they're doing. And, I'm also very lucky, we've got Ollie who runs our platform. Similar thing. He comes from a startup background as well. So, and normally they're challenging me for being too corporate all the time. And, they're focused. So they are naturally, and we spend a lot of time figuring out who are the right investors that we want to kind of work with based on, where we think we can add value. Again, apologies for using the word value. People will cringe when I say it, but when you look at a cap table, what is each individual investor adding? What are they adding beyond simply the money that they can kind of put into something? And again, if you look at our ads, obviously we're uniquely placed from a automotive perspective. We're also owned by the Tata Group, so JLR's ultimate parent is the Tata Group. And so we have links in with a number of Tata Group companies as well. Now, not just in the automotive space. Tata's got, I think 1,000 different companies within it. It's, I think, the 19th or certainly the top 20 biggest, companies or groups in the world. Whether that's hotels or steel manufacturer or automotive or basically anything that you can kind of think of. And that allows us to take a much kind of broader view and means that when we're looking at investing in startups, JLR is a relatively small company in the automotive, and corporate space. It's a very important one in the UK in particular. But if you look at globally, a startup will not be successful if it's working exclusively with JLR, right? It will limit its growth. So this is where our financial hat starts to think, well, what do we do and how do we help these companies grow within automotive? And in fact, if you look at our co-investors, we invest a lot with JLR's competitors, right? So, we're on the cap table with our friends at BMW Ventures, with the Volvo Tech Fund, with Hyundai, with Porsche, which some people find, quite surprising that we would kind of do that. But we're all attempting to take on some of the biggest challenges that I believe exist in not only automotive, but also in kind of enterprises, that we've probably seen for, 100 years or whatever it is. So we've got to work together in this space. And also I know how incredibly talented those people are as well. And therefore it's a de-risking point for me if I see something that comes from, from our fellow CVCs. In terms of the VCs that we want to work with, one of the advantages, again, that we have, we invest, as you said, Andreas, in climate, industrial, and enterprise technologies. These are quite broad themes deliberately, because we didn't want to have kind of themes that we had to chop and change every 18 months or 2 years. These are things that, will hopefully, whilst the specifics or the details of it may change, those themes will stay with us for the next 5 years, that or longer. That's what we've developed, because as a seed and Series A investor, we're in this for the next 5 to 10 years anyway. So it's got to be able to kind of, last that long. The great thing about the VC space is there are so many people who are specific, that they're so focused on individual areas, and that level of expertise, I think, is incredibly important. And, you mentioned Firefly as one of the companies that, we invested in, and working together with Ido in the team, at Firefly, I think that opened us up to a number of investors who, said to us that they were really surprised that, we were looking in this space at all. The natural assumption is you're just looking at, batteries and smart cities and micro mobility and all of those kind of things. But actually, when you look at the enterprise space, whether that's, quantum, AI, sensors, cyber, space technologies, all of those kind of things, it opens you up to, an infinite number of possibilities. And that's what we're really looking for. And those people that really know who they are really able to identify incredible, startups, but are looking for potentially their first corporate investor from whether it's the first enterprise investor or the first automotive investor, that kind of thing, where we can be of some value to both the investor and the startup.
But I think it's super interesting with these, with these investment verticals, right? That you normally have. A lot of VCs tend to forget that you also have the horizontal investment strategies. So you have all functions within JLR, right? You have the expertise. And I think where we ended up looking at something was just pure procurement, right? We got into, that's super interesting, right? And we can deploy the different technologies and software that is being developed. So I think, as you mature over the 2 years and so forth, just, having that playing field towards VCs, super interesting.
And I think also your credibility grows in those spaces as well. So, we found, so Louis, who's responsible for our climate tech investing, he's found over the last 2 years, as well as he started to reach out, you realize that there are some really amazing things that are going on, such as the Drop, which was a climate conference that he attended. And he said that it was the best thing he's ever been to. It was very specific. It was very targeted. I can say that it wasn't just virtue signaling, right? It wasn't just a bunch of corporates standing on a stage talking about how amazing they are at doing X, Y, and Z. These were people rolling their sleeves up and doing some work, at something. So, it's and I think those are the areas where, if I compare it to what I hear from Will, who's based in San Francisco, the events that he goes to, because as we all know, in the Bay Area, you can go to something every single night. I mean, he's practically nocturnal. So, there's things that are going on, there. And, he will say that it's just a natural thing that in the room you have corporates and VCs, who are, actively working with each other. Because again, this ecosystem is a word that gets used, in horrendous ways, I think, sometimes. But an ecosystem is something that where every participant adds value to each other. And I think that's the bit that, without sounding too TED talky about it, those are the bits that I think we're really starting to see now, once we built up the credibility. And I think that's the most important thing. It's taken us a while to build that. And the most important thing for us now is to deliver on that. That's our main focus over the next 12 months is, we have persuaded founders to take our money, right? And that's another thing that corporates find quite difficult to say. But surely, these are small companies. They must be desperate to work with us. And it's like, well, no, that's not actually the case. The types of founders that we want to work with, the exceptional founders that we want to work with, everybody else wants to work with too. So how do you persuade them that you're the right person to give them money? And then once you've done that piece, you've then got to deliver on what you said you would do. And we've termed that the reverse pitch. Yeah. We spend quite a lot of time, particularly, and we still do it, and we will continue doing it, pitching ourselves to both investors and startups to say why we should be in a deal,
Could you comment a bit on what Mike said earlier when he was preparing for the job and reading in a book in a textbook that was saying the last thing you want in a CVC is someone internal to run it, because that runs a bit counter to many of the conversations we've had early on this show, because we've often heard that the last thing you want to do is actually have someone from the outside running it, because then you don't understand the motives and the inner workings of the corporate, and it will just end up wrong.
So I would normally preach the opposite, because my own learning and what I've seen is that if you create a corporate venturing entity without the integration into the core or the mothership, right, then you tend to not be able to do the collaboration side. So I listened carefully, Mike, when you spoke earlier on your team, and I really agree, but it needs to be a mix, right? My early days in CVCs, we had an amazing managing partner. He could kick in all the doors, but he had a little bit of sharp elbows. And the ability to do collaboration after that was hard, right? The second managing partner that turned up came with 20 years of experience from the strategy division and sales division. And for me, then I could start to collaborate. But I think it also goes with, where are you in the lifetime of the corporate venturing entity? What needs to be done? Who has taken the decision to create the CV, right? So we were not fully onboarded in the C-suite when we started out. So a lot of work needed to be done from there on. But for me, I think what is nice to hear from you, Mike, is that you have this collaboration, right? That is going on, and then you have all the investors behind you. But maybe, Mike, you could also share a little bit more about, how do you leverage your background from your past, right, in how you operate the CV entity.
Yeah, and again, I think I probably shouldn't have or I should have said, Andreas, that the book I read was quite old.
Yeah.
So I do think there's been a genuine shift, because I think, to Jeppe's point, I think that the VC is obviously an incredibly specialist and incredibly important. If you take someone in a VC, they're just different people, right? They're wired in a completely different way, which is why it's quite kind of interesting from a corporate perspective that not only are startups and corporates very different, VC people and corporate people are very different as well. And just going back on my kind of experience, I kind of joined. You always look at these things backwards, right? It just wasn't planned, and I think many people who end up in VC or CVC kind of didn't. This wasn't a purposeful path that they followed. Particularly when you're as old as I am, that when these things kind of didn't exist. It might be different now, where people are more aware of VC, through university and things like that. But if you look at my background, there's two things. One, I've been very fortunate. I started off at the graduate scheme at the Gillette company in London, then was acquired by Procter & Gamble, but I've also worked for the Virgin Group and also for Walgreens Boots Alliance, that owns Boots pharmacies, as well as a wholesaling business and Walgreens in the US. And as a finance person, you're always used to having one foot in the finance team, who always say no to everything, and then one foot in the leadership team of a business unit. And actually taking that to the next level, I've always ended up in roles where I've been in either a division or a part of the business. Even my last role, it was a joint venture, right? It wasn't in the core. So I'm used to working on the periphery of a large organization. And therefore I'm used to being punched in the face from two directions, right? You're either too corporate, or, you've gone native, which is the expression that finance people use when, they say that you're too biased to the business unit and all of those kind of things. So I've kind of grown up with that in a way. My first graduate role, 8 of the 9 graduates that were taken on in my cohort went to work in the head office, and I was sent to a factory, 50 kilometers away. So even in my first assignment,
Mike, there is a phrase amongst VCs, and it has been a while since I've been a VC, right? But there's this, investing is an art, not a science, right? so how does that go with you?
Well, it's true, right? And I think that it comes into the decision making, right? So we all know that venture capital is inherently risky, right? That's why it's called venture capital to begin with. So we've got to provide, and I'm here because we know that 90% of the things that we invested will be lucky if we get our money back, right? That's the game that we're in, and you have to accept that before you start, because if you can't accept that, then there's no point even trying, but don't get me wrong, if we see a startup that unfortunately does fail, you still take it incredibly personally, you still beat yourself up about it, but you've then got to move on, and you've then got to write the next check, and you've then got to go again. And the really important thing for me is, at that point when you make a decision, are you making that decision with the best information that you have? You're making it that's totally aligned with your thesis, that's totally aligned with everything that you've done, so that at that point that you invest in it, that was the best decision that you could have made. There's nothing worse. And we had it with a company from our pre-reset, almost our legacy portfolio, that kind of failed, and we were completely helpless. We couldn't help them in any way, because it was so detracted from what it was that we could do, how we could help. And therefore you kind of sit there and go, everyone accepts that not everything's going to work in the way that you wanted it to work. But what you've got to stand behind is, at the point you made the decision, was it a really solid one, as solid as you could get it? And the way we look at it is, and again, was the potential financial returns, were they there? was this a company that you could have seen the potential to get your 5, 10, 20x, 50x, whatever it is? Was the potential there? Was it a solid VC investment? You then go into, were they the right ones at the time? When we did the market map, when we really looked at their competitors, when we did the diligence, were they the one that we should have put our bets on? And then the final one was, at the time, where was the strategic alignment? Like, what is it? Where is it that we thought they could help? Now, we're not one of those funds that requires you to have a contract in place or a POC or any of those kind of things. Not at all. But the potential has to be there. So, when we use the diligence from the business units, we talk to people and we say, right, is this where you want to go? Now, of course, things change, right? But at that time, and that's the bit, if you've got that you can hold on to, then I think, to your point, you can then stand behind something that doesn't work in the way that you expected it to work. And you say, well, that's the nature of venture capital and corporate venture capital. Otherwise, we go back to the thing that we're just a corporate dev function that's looking for, 1.1, 1.2, and we're looking for that. That isn't, the game that we're in. And I think, in a way, having someone who spent, as I said, 25 years in the finance world, I think I bring that level of credibility into the corporate, right? Because, having been a member of JLR's finance leadership team, if I didn't think this was worth my time and I didn't think it was the right thing for the company, then I wouldn't be doing it. I would have gone and done something else. Because, as you know, JP, sometimes this job is hard, right? Because
it's very difficult. Very difficult.
And there are easier ways of making money in a corporate than trying to sometimes help itself, and to be the one that's really pushing the things that you really believe in. And that first kind of 12 to 18 months was incredibly difficult to build that credibility. Once you get the successes, once you get the communication right internally, once you have, and the approach we've taken, again, learning from the real experts, and I'm definitely not one of them, making sure that when you announce something good, or when you talk about something, it's always the business unit, right? You always shine the light on the business unit. You don't shine the light on the VC people. We have our own little celebration, and we do our own little thing, but it's all about them. And then that just brings more and more, things to you. And again, just finally is, I've been very fortunate. I've worked in London, Frankfurt, Geneva, Shanghai, and New York, right? But never for a bank, right? So somehow there must have been like an investor thing in there somewhere that was just waiting to come out. And as you can tell, because I'm waffling so much, this is the best job I've had in 25 years. And it's one in which I think brings together all of the things that I've, learned, because, as you guys know better than I do, the numbers element of what we do is 10%.
But I think that's spot on what you said there, Mike, because what excites me about corporate venturing is that you can take the investments into startups, and then you can make them leapfrog through the collaboration with the corporations. And it's so few VCs and GPs in general that aim to do that, because in Europe, the GPs have not really started to engage with corporations yet. They do that on the American side of things, right? Because they know they need to exit their companies. It's like the European GPs, they're not there yet, right? They need to start working on that. And then, of course, we need European corporates to start buying also, right? So I think it's just a different matter of how to work with it.
Mike, you said just before, let me put it this way. Now we've spoken about both how you position yourself in the market, the importance of the value add, how you bring your startups and even the ones you don't invest with closer to the JLR and the Tata Group. We've spoken about how you try and manage the relationship towards the corporate owner and how you do that. We have not spoken, and this is of course in the context of the reset, the reinvention, so to say, of InVenture. I'd love to ask you about those 10% that are the numbers, because in venture, when we build our in pure venture, when we build our investment strategies, make decisions around, do you want to lead or do you want to co-invest? How many investments do you do out of the full fund? So on and so forth. I'd love to ask you, when you went in, because part of one thing was that you did a reset in terms of the other parts of the equation, but you also did, of course, the investment side. You said, okay, what's going to be our investment strategy? How many deals per year? The sizes we mentioned before, I think we said 250K all the way up to 2 million. You invest out of the balance sheet. But how do you think about this? As an example, as a VC, you often make the decision between leading or co-investing. And you often either say, well, it's a small fund, so for that reason, I co-invest purely. And then you have one specific way of acting in the market versus if you're leading. And if you're leading, you might only say, well, we want to lead up to this stage. And we also only want to lead 6 of our 20 investments because we don't think we have capacity for more, or you say we co-lead and so on. How do you think about these dynamics as a corporate investor?
Yeah, that's a great question. We made a decision very early on that we would co-invest. So we would not look to lead rounds. And part of that is because we were a team of 2. We're now a team of 3 in terms of our investment team. So we have Sam, Louis, and Eddie, and that's kind of it. And therefore, to lead a round, I think, and also we didn't have, and we still don't really have a strong enough network to do that. And I think if you are someone who's going to talk to a founder about leading their round, again, it goes back to the reverse pitch, right? They're really, we're talking to a company right now who's looking at fundraising at some point in the next kind of 3 or 4 months. They're talking to 3 or 4, leads about what term sheet they're going to put down, what are they going to offer, what do they bring, and all of those things. So we did not, and we still do not have the right to play in that space. And I think that, like any strategy or any reset, you've got to think, what have I got that no one else has got that I can exploit? And then what can, where do I, and again, I'm going to mention that word value. I promised I wouldn't in this conversation, but what am I bringing? What am I bringing that's different, right? What am I bringing that would persuade a founder or a lead investor or another investor to ring either Sam, Louis, Eddie or myself up and say, look, we've got this thing. What do you think? It would be great to get you in. We also don't deploy that much capital. We don't disclose how much we do in kind of have as our capital allocation, but it's not enough to be a serious leader of a round. So some of that's practical, I think, but also, we decided very early on that, and again, maybe Jeppe, you'll know more about this than me, right? But we decided that we wanted to be famous, if that's or have a brand. Maybe famous is the wrong word, but we wanted to have a brand of a group of people who were really good to work with, that delivered on the promises that they made and that stood for something, right? We didn't, and I hear lots of horror stories about VCs and CVCs, some people aren't very nice to work with and all of those kind of things. But and part of that is the nature of, the amazing team that I have, is that they're all, very incredibly talented and clever in what they do, but they're also decent human beings, right? That's at the core of who we are as a group of people. So therefore, when we make an investment and we want to be part of that startup's journey, we wanted to be somebody that was going to work with them for a long period. Because again, if you're investing at pre-seed or seed, you're in this for 7-10 years, right? This isn't something where you're looking to do a quick turn, get your 1.5, 2x and then get out again. That's not what we kind of wanted to be. And that's because that's the people that we are. So a lot of that kind of drove that. And therefore what we found is that what we can add, the value that we can add, that we can bring is, making things happen. As I said, 90% of our active portfolio today is working with JLR in some way, right? So of the 23 companies, 90% are working with them. And that's really important because, again, that builds credibility and that builds the virtuous circle of, and again, one of our other core values was, if it is a value, is doing what we say we're going to do, right? And again, you know better than me, this is an industry where people do a lot of talking, but not, I see less on the delivery side. And maybe this is where my finance background is kicking in, because I'm like, okay, where is it? What's the impact? What is it, that we're looking to do?
Just commenting on some of the things you said there, Mike. I think it's really clever that you don't lead for two reasons, right? The first one is that CVCs tend to increase the valuation of a startup when they lead, and that might make it difficult for the startup to do their next round. So I think that there's something in there that is super important, right? So, but later on you'll become eager to lead the rounds, because that's where, when you start to become a little bit cocky and say, well, I figured this out, right? So I think, it'll be interesting to have this discussion with you in a couple of years and see, have you actually changed that statement? But from the get-go, I think it's a very, very clever decision to start with not leading. Again,
lots of things have changed, and in the same way that startups do, right? You pivot and you move through and you change things as you go. But that, some of those almost rules that we set up at the very beginning about the why and the how has not changed. What we have done is we've really focused on the governance and speeding up our decision making, because that was, again, this is another thing that gets thrown at CVCs a lot in terms of, how many, months or years it takes them to make a decision. We really wanted to make sure that, and we spent a lot of time in the planning, so that when we did go live, it took us about 7 months, I think, between, my arrival and when we started to deploy money against the thesis and the way that we're doing it. Because what we wanted to do was not to, Andreas, your first question, is not be someone who turned up for 6 months and then disappeared for a year, and then we came back again, and then, because you lose credibility. They're like, what are you doing here? So it was really important that we spent the time in the planning and the preparation, so that when we started, we didn't stop. This just creates momentum. And of course, we shift and pivot like, anyone doing anything, new will do. But, those values that we had just have maintained. And yeah, if I'm around in a couple of years, Jeppe, we should keep talking.
I think when you go into corporate venturing from the corporate side, you tend never to want to leave the ecosystem. So in some way or form, Mike, you're stuck in here, right? And that's what I've seen with everybody that I've met in corporate venturing, because it's beautiful to work with startups and new technologies.
You're absolutely right. And again, for corporates as well, if you think about what's going on in, I think everyone's read the press at the moment about what's going on in automotive, more generally in Europe, but also any large corporate, I think, in Europe at the moment. Some of the conversations that corporate leaders are having, they're quite hard at the moment. There's everyone's struggling for growth. There's cost of living, revenues, cost, governments are changing, and they're putting, taxes up here and pushing, different pots of money around. It's hard to work in a corporate right now, and keeping the lights on in a corporate and keeping the machine running is an incredibly difficult kind of period. Therefore, if you can bring a startup into that conversation, that's the best conversation that person would have had all week, all month, all year, potentially. So therefore, what you've got to avoid, in my view, is, but that conversation's got to go somewhere. You can't just, send a corporate leader, 6,000 startups and say, pick one and we'll have a chat. Or you can't waste a founder's time talking to someone in the corporate, which is, will never go anywhere. And you knew it was never going to go anywhere, when you were pushing the invite in. So making sure that you build that credibility that way, I think is important. But, Jeppe, you're exactly right. I mean, we are a separate entity. We are based in London. The parent headquarters is in the Midlands of the UK, which is about 2 hours away on the train from London. We have a small office with just us in there. And you're right. These are great. It's incredibly fun conversations to have. It's incredibly challenging. It's probably the hardest I've ever worked, but it's also the most rewarding and most enjoyable as well. And
yeah, there's an excellent question for you now, and a little bit back to the script, right? Having come with the background that you have, what is kind of your most counterintuitive learning in corporate venturing for you?
The counterintuitive piece for me is the level of collaboration between companies that I would perceive as competitors, and the fact that how open everybody is. Because again, I'm used to kind of working in environments where, in fast moving consumer goods or in retail, it's an incredibly competitive space. So you're always looking at your rival, you're always looking at the people in your ecosystem, and you're trying to, every day you're thinking, particularly in retail, where you get your sales on a daily basis, that you're always comparing yourself to somebody else, a big supermarket, a big retailer, or, if you're in a brand like Gillette, you're comparing yourself to Wilkinson Sword, or you're comparing yourself to, to these other kind of things. So therefore, you're always looking at your competition with a bit of, your teeth are great, you're ready to go for them kind of thing. Whereas, when I talk to, my peers, we were, just to give you an example, we were in Korea last month, in South Korea, and we spoke to the guys at Hyundai, who we know quite well, and we said, literally, we're going to be in town. Can we come and spend the day with you? And because we really want to learn. I mean, I think Hyundai, Mobis, and Cradle is a group of people who are doing some amazing things, and in the automotive space, and people that I look at with a lot of envy, and I think that this is where I want us to get to. I want us to be kind of where these guys are. And the doors were, we had a great conversation with Keith and Sukhwan and Guillaume, in his office. And it just so happened that was their innovation week that they were having, in there. And they were like, yeah, come along, come, and it was great, whereas I would be, let's meet maybe in a Starbucks around the corner. So nobody knows we're having this conversation.
But that's just super interesting, right? Because in the ecosystem, right? It's about sharing your learnings and learn as much to drive these startups forward, right? And that is what I think you're experiencing, right?
Yeah, completely. And also take sustainability as an example, right? We all know that we've got a climate crisis and all of these things. And, this is going to cost hundreds of billions, if not hundreds of trillions of dollars to fix, right? And therefore, not even Sequoia or, Andreessen Horowitz or all of the, they haven't got enough money to solve this on their own. We've got to work together. And particularly in automotive, again, with the regulations and, with the way in which kind of car platforms and customers and clients are used to engaging with their vehicles, that coming at this from an industry perspective is so much easier and less risky and less costly than trying to do, a JLR version of this and a BMW version of that and a Ford version of this. And I think that, and even, within our relationship with Global Corporate Venturing, there is a mobility council that, we're a part of. And in that group are, again, GM's in there, BMW's in there, Volvo's in there, so we're able to have that conversation to say, what are you learning? And again, the adjacencies from other industries. If I take Uncaged, which is a bio-leather company that we've invested in, so biomaterials company that we've invested in, we know that automotive grade, coverings and things like that are going to take a number of years to kind of work with. So they've been working with fashion houses and with other things because, making belts and wallets and purses and bags and sneakers and all these other kind of things have a lot less, regulation and, fire, things and crash testing and all of those kind of things than you need if you're going to put it in a car seat or on a dash or something like that. So we've got to get outside. And then you think, again, back to climate, 50% of the climate problem is technological and financial, right? The other 50% is psychological, right? So now we've got to try and talk to people about, buying a car maybe in a different way. We've got to talk to people about the materials in the vehicle maybe being recycled, or we've got to look at alternative materials. And we've been telling people for the entire auto industry has been telling people for 100 years that certain materials are more premium than others. If you look at the fashion industry, they've been saying that, again, certain materials are more premium than others. We've got another portfolio company called Gen Phoenix, who've been working with other corporates, so Dr. Martens with their investment arm and Tapestry with their investment arm to produce, a Dr. Martens boot with a recycled leather product. So how do they talk to their customers about what this is? Because we know that right now, whether we like it or not, customers and clients are not willing to sacrifice price or performance for their sustainability credentials.
For sure.
Right. So that's the problem that we've got now. So how do you take materials, advanced materials, and put them up against a 100-year-old industry that's been cost engineered to hell, that's been optimized completely, and then bring this other material in, and then go, ta-da, this is going to cost you 10 times as much, and we're not quite sure how it's going to react in 10 years. You'll get laughed out and thrown out. And this is why I think some of these materials, if you look at some, these fruit leathers, vegetable leather, all of these other things, I think have really struggled because potentially they've not had that level of corporate insight into building their companies and the brand, which is why we're so excited about what Stephanie and the team are doing.
I would love at a later point of time, and maybe you could just mention your thoughts briefly, right? This doing letter of intent with some of your portfolio companies, specifically on the sustainability side, right? Because as you say, nobody wants to pay more for this, right? It needs to be as convenient, right? But is that something you do and have done with any of your portfolio companies?
So we are working on proof of concepts right now with our company. So if we look at, so of the 90% of our companies that are engaged with JLR in some way, I would say half of them are running proof of concepts and projects with JLR right now. So again, we're, as an automotive company, we're very lucky that we're used to long time cycles, and we also have internal R&D functions, and we have labs, and we have things which is incredibly valuable to a startup, right? Because they're not having to send their things away to a lab to pay to get it tested and then bring that to another company and say, and all they do would just be to say, well, who are those people you've got that checked with? We can do that in-house with them and give them instant feedback, and we can give them access to whether it's sandboxed, kind of dummy data, whatever it would be in a, and again, a sandbox data environment that allows them to run things, again, incredibly safe way. And that allows them to prove their point. I'm always a little bit worried about these letters of intent, because I kind of worried if you were that intent on working with them, you'd do more than a letter. You would do something with them
and do a contract.
Yeah, exactly. And again, we share that, because one of the great things about what we've noticed about lead investors, good lead investors, by the way, is that they'll share the data with you. They'll share, as much as they can and feel comfortable, the diligence that they've done. And likewise, when we do stuff, and again, it's got to be okay with everybody, the corporate, the startup, and everything. Of course, we'd share the information that we've got as well, because that's what we're bringing. Again, it goes back to everyone adding value to each other. Otherwise, it just becomes transactional. And then how we started this conversation, Andreas, just gets thrown back. Well, it's just corporates playing, or they're trying to steal information. They're trying to take all your info, and try and ruin you, and all of those kind of things. That's a, again, sorry, as you can tell, I get quite passionate about these things. I was never this passionate about finance stuff and international reporting standards and all of those things.
Yeah.
Well, some of that is also part of venture, but no, that's not the parts people typically are most passionate about. I think to your point about collaboration and the partnership of the industry, I kind of liken it to elite runners and so on, that they're incredibly collaborative and friendly up until they run the race, and then when you run the race, you're on. Similar, when you have those 4 term sheets delivered by the leads, they're doing everything they can to win. But then right after and all the way up to that, you're collaborating, and you have GPs that are best friends, that are then competing against each other for 2 weeks or 3 weeks or whatever in a deal. And then after that, they go back to being best friends. So one of them might lead and the other is then only given a follower ticket. And it is what it is, right? But you're back to collaborating, because that's the nature of this game. And that's also why I love venture and why I'm in venture. One is the collaboration. The other is that it's long-term. So it means that every single interaction is much more transparent, much more honest, much more, long-term, collaboratively oriented, in the sense that, you can be collaborative for 3 months, and that's not the same as if you're collaborative knowing we're going to be together for the next 15 years. I really, really love the industry for that particular part.
No, I do agree with you. And one of the things I just want to add on what you've just said about the elite runners and all of those things is, if one of our portfolio companies wins a contract with JLR, it does it on its own merits through the procurement process with JLR. We do not interfere in that process in any way. So, and this is about the collaboration, the support, and the help. But when you go into, the official procurement process with JLR, then you're not necessarily on your own, but you're doing that on the merits of what your product is, the performance. And, of course, we can maybe help open that door a little bit wider than maybe it would have been to get you into the short list, or the list of 30 companies that they think of before they get that. But if you don't get into that final 3, I can't get you into that 3. That's not what we're here to do. And if we, and we are very, very clear that there is a very thick line between what we do as InMotion Ventures, the startup, and the corporate, because we're an investor. So we have access to information about the startup, confidential information about the startup. We also have confidential information about JLR. We do not share them, because once we do that once, then we're toast. So it's a line that you never ever get anywhere near, and that's something that we hold, kind of incredibly dear. Again, it's one of our principal values as we work through.
Yeah, but Mike, thank you so much for joining for this episode. I absolutely enjoyed it. I think every time we do these, it proves to me why it's so important that we do them. I think what you said, Mike, is also spot on when it comes to the conferences, that it's so wrong that we have so many things that are pure VC, or when you have VC conferences and then there's a CVC side to it, and then oftentimes it's actually a bit of sidetrack or something like that. Yes, there's stuff that the CVC should care more about and do care more about, but I think we should focus a bit more on the mingling the two sides of the ecosystem more.
No, completely. And again, just on that point, I think interactions with GPs and VCs tends to be almost them wanting you to invest in their fund rather than wanting to actually talk about what they're seeing right now. How can we work together? It tends to be more a case of so do you invest in fund of funds? And so I think we need, as you say, I think hopefully this is and you guys are doing an amazing job of highlighting this, and I think it will only grow from these discussions and the similar discussions you have. But there are some amazing VCs out there. You mentioned Emerald already, who we know very well, and and do incredible work. And the more that we can work together with with groups like that, I think it helps everybody.
It's actually funny, right? Because the part around the fund investing part, you might not be doing it now, but it's not like JLR and Tata Group doesn't have the means. It's just not in the strategy right now. So if you do, if you would choose to do it 5 years down the road, well, who would you be investing in? Probably the teams you've been collaborating closely with over the last period, right? So
yeah,
it's only win-win, so to say. Yes, it might not be today that you'll get an LP investment. If it happens, it's definitely going to happen with the group that the team is working with closely.
Sure.
All right, gentlemen, thank you so much once again. I enjoy these episodes so much.
Thank you for having me.
Yeah, thank you for having me.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.